An interesting debate has erupted between fund managers in India's mutual fund industries. ICICI Pru Chief Investment Officer S. Naren said at an event that people should get out of systematic investment plans in small cap funds. And as he said that, others have jumped on him, saying that obviously in the long term, everything will be fine. Naren had said in a talk that he thought it was time to take out lock, stock, and barrel from small and mid caps. He also said that the entire risk is now borne by you, the distributor, and the investor, 100%. So the entire problem of any loss will be borne by you. That's 100%. And technically, obviously, he's right. Of course, the rest of the industry sees this as breaking ranks, though I would see it as the travails of an investment manager expressing his frustration because his sales colleagues are able to only sell small cap and mid cap stock funds or much more easily than, say, large cap. He said that I do not believe that this is the time to invest in small and mid cap systematic investment plans, but I'm unable to convince my sales colleagues. I tried my best but failed, he says. But he also says, I believe that this is the time to stop SIPs and small and mid caps because they're so overvalued. Essentially, he's saying that people will lose their shirts and they will suffer more than the mutual fund or asset management company if you continue to invest in small and mid cap stocks, which are obviously overvalued. And this, of course, is something that almost every fund manager off or on record, those who say so, have been saying so. And guests on the core report have also consistently pointed to the dangers of plunging into small and mid caps and highlighting the overvaluations. Of course, the problem is that in this period, that while everyone has been saying or pointing to the problems of high valuations, the markets have corrected, gone up and gone down again. So there you are. So I reached out to G. Chokalingam, founder of Economics Research, and I began by asking him to take a broader look at the markets and these recent comments.
To some extent, it may be applicable to mutual fund industry. Maybe. The way the mutual fund invests is different from the PMS people investment. And these two are different from individual retail investors investment, the HNI investment. So the patterns are extremely different. Now, mutual funds have inherent constraints. Now, they cannot invest in illiquid stocks or very low liquidity, low small cap, too small cap, because if there is a redemption, they have to give. So, therefore, in the industry, what happens? They invest large amount of money index-based small and mid caps. So, there is a structural change. If you see over last 20, 30 years, what was a large cap now has become a small cap in terms of the category. 30 years back, large cap used to be about 10,000 crore. Last year at the peak of the bull, beyond 250 stock, it is small cap. And 251 stock, rank number 251 stock, its market cap was 30,000 crore, which we used to call large cap 30 years ago. So the point I'm trying to tell you is that because of the nature of the mutual fund, they tend to invest largely, the index-based small cap stocks, index-based mid-cap stocks. And invariably, most of them are costly in valuation. It is very difficult to find cheaply valued stocks in the top 10, 20 index stocks. And they can't go for bottom-up approach in terms of cheaply valued but illiquid. So, therefore, there can be a constraint. But this is not applicable for equity investing for everybody. Now, first of all, in bear market, I have seen bubble in the individual small and mid-cap stocks. In the bull market, I have seen very cheaply valued small and mid-cap stocks because the universe is more than 4,000 now. So there are few hundred stocks one can always find comfort in the bull market. In the bear market also, one can find a lot of stocks attractive valued. So if you are not willing to invest in the bear market, that too now 70 lakh crore rupees, 70 trillion meltdown has already happened. Now, after this also, if you don't find comfort in any individual stock, then when will you find? So, point one, the universe is too big. Your logic of median and all may not be applicable. And two, SMC, small and mid-cap stock, is not a homogeneous group. It is heterogeneous. So many diversities within that. So, irrespective of the market condition, you always find bubble and opportunities. Third, market is down 70 trillion rupees. So, it has really thrown a lot of opportunities. Fourth, even if you assume this is the time to get out of small and mid cap, Now, on the other hand, FIs are selling every day, and most of their sellings are happening in the large cap. So, does it mean that you stay away from the whole market itself? Then everybody tends to think then what you saw during COVID pandemic, double that pain or 10 times that pain will see. So that is not the way the market behaves. Yes, I do agree. The mutual fund managers have certain limitation, but that is not applicable to all other investors. It is proven again and again, particularly the most successful investors are the one who has accumulated a lot of quality stocks in the bear market, not the one accumulates in the bull market to make a lot of wealth.
But there is a specific demand supply challenge, as in there's too much supply because investors are consistently putting money into systematic investment plans of mutual funds for small and mid cap investing, and which is perhaps where they find it more attractive or lucrative. And the fund manager herself or himself is struggling because obviously right now valuations are high and overall market forecast for this year at least is not looking as bullish as it was earlier. So to that extent, is the ICICI Prudential fund manager fair in saying that, maybe you guys need to pull out right now and maybe come back later? I'm not sure he said that, but I'm sure he means that.
Last year at the peak of the bull market, they said we stopped taking money. After 70 trillion washout, are we panicking on the valuation? We may be panicking on the market. The market might correct, but that is pattern of the markets. In 2010 November, 2013 November, if my memory is right, Sensex was down more than 25%, 20-25%. So all mutual funds had a negative. So we have to accept that. But the point is, it doesn't mean that you have to invest in the overvalued stocks. Today, what is the problem? A lot of IPOs, the companies which qualify as a venture funds, before the venture fund cycle got successfully completed, they rushed to the market and listed. What I mean, the loss making. And they are down 50%. And some of the companies which were doing a traditional business on a digital platform suddenly got overvalued 100 PE, 80 PE, and they are the stock which are down 50%. So bad experiences should not guide you to create aversion. There are hundreds of small and mid-cap stocks still reasonably valued. So that's an opportunity. So therefore, I would say that don't shun the pocket of small and mid-cap category as a whole. Within that, shun segment of overvalued stocks. So that is a challenge for the fund managers.
Correct. Your advice is to the fund manager or to the investor in the fund which is being managed by the fund manager?
I would say that even fund manager has to do this. There are various segments, but you caution the investors, that because India's story ultimately is a great story. A lot of small caps only eventually evolved as a large cap. Infosys was a small cap. If you permit me to quote, when I placed an order for Wipro in 92, 93 or 93, 94, my dealer refused to accept my order. He said, sir, it's a tiny small cap. I'm sorry, I cannot spend enough time to buy for you.
But was it even an IT company at that time? Or I think it was a Vanaspati company or something.
It was a diversified company, but IT business was, if my memory is right, around 750 crore revenue. It was a dominant source of, it was a diversified company. So, small caps only evolved largely. Now also, if you see, 2/3 of the large caps debuted as a small cap. But recent time, the large caps directly debuted as a large cap because the market dynamic changed. The entire market cap has shifted vertically, and there are a lot of big companies also coming, starting with the TCS. But otherwise, traditionally, the small cap evolves as a large cap. And as I mentioned, you have to make a distinction between the category as a whole, the pockets of overvaluation. To give an example, BSE, it was 150 rupees if you adjust for the bonus. It has gone up 30 times. I'm not making any view on the stock. So the point I'm saying, such a tiny small cap, it has become a reasonably large cap. To deal with the problem, maybe you position your small and mid cap as a 3-year fund, 5-year fund. Tell them that within 3 year, 5 year, it's a closed ended. You cannot take the money, but you invest in the stocks where you have got a lot of appealing valuation. So that is the way that a lot of HNIs have made enormous wealth in the country. That is the way many professional investors make investments. still, I should admit that they have a problem. They have to invest as a fund as a whole. So they find it very difficult to concentrate in deep value, small cap, illiquid counters. So one should agree that limitation. I mean, one should accept that limitation. Otherwise, opportunities are there.
Right, Choka, thank you so much for joining me and sharing